Morning and welcome to On the Money right here on WDBO AM 580. Always streaming inside your WDBO app. If you find yourself in that app with a question, I invite you to open it up, push the open mic button down at the bottom, and send in your best 10 to 15 seconds with whatever you may have heard in the news this week, in the trades last week, in the futures next week, or on Back to the Future, or whatever they predicted a while back, and you want to just run it by the team at Certified Financial Group. That's what this show is. Again, On the Money, brought to you by the team at Certified Financial Group. Over 400 years experience combined of to be partnering with them as we have for nearly 4 decades on the airwaves of WDBO. Today we got Joe Bert and Dillon Little bringing us some info. Gentlemen, how are we doing today?
We're doing great, Josh. Good to be with you. Good to be with you. As you said in the intro, Dillon and I are here to take calls that might be on our listeners' minds, things that you've been thinking about regarding your IRA, a 401k, long-term health care, reverse mortgages, stocks, bonds, real estate, all that stuff that Dillon and I and the 15 other certified financial planners deal with day in and day out, getting our clients to and through their retirement years, providing retirement planning and investment management for a fee. But on Saturday morning, we are here for you, as I say, absolutely free. So if there's anything on your mind, things you've been thinking about, rumors that you've heard, things you want to discuss, we are here, we are here, we are here. The good news for you is the lines are absolutely wide open. So all you have to do is pick up the phone and dial these magic numbers.
844-580-9326, 844-580-WDBO. And again, open mic available inside the WDBO app as another way to join the program. The topic of today's show is Millennials and Gen Z-ers. They have not experienced a bear market yet. What will they do when one hits?
Good question. What do you think, Dillon?
Well, Joe, for our listeners that don't know, millennials are those born 1981 to 1996. Gen Zers, those 97 to 2012. So that's anybody ages 13 to 41. So it's a pretty broad range.
That is a broad range.
Our country out there, young investors.
28 years.
That's right. I'm a Gen Zer myself.
Uh-huh.
But
so what are you going to do?
So what am I going to do?
You haven't experienced a bear market.
I have not.
The ugliness of it.
So the last bear market, and we're going to define a bear market as a decline in a major index of 20% lasting at least 2 quarters. Mm-hmm. So a sustained decline. This year we've experienced the tariff tantrum, which was a temporary V-shaped decline, not long enough to be considered a bear market. We had the interest rate hike in 2022, again, not quite 2 quarters. COVID, immediate recovery. So we haven't experienced a bear market lasting 2 quarters since March of 2009, ending March of 2009. So we're 16 and a half years removed from the last bear market ending. We get them on average every 5.5 years, and it's an average decline of 34% in equity. So we're about 11 years overdue since the last bear market. We haven't experienced one in quite a while. So pretty much all Gen Z investors, and I would say most of millennial investors, have not experienced one. So the question is what to do when that happens. My crystal ball isn't predicting a bear market, but I know that we're at least 16 and a half years closer to the next one than we were to the last one.
That's for sure. I like the way you said that. Say that again. We're 16
and a half years removed from the last bear market, so my crystal ball doesn't know when the next will happen, but I do know that we're 16 and a half years at least closer to the next one.
There you go. So it's coming, folks. The storm is coming. It's just the question is when, and what will the millennials do, the Gen Zers do, right?
That's right.
So what's your crystal ball tell you there?
So my crystal ball says to do absolutely nothing. Us as humans, it's natural to sometimes let our emotions get the best of us. Sometimes our emotions can be our worst enemy. Investing is a marathon. It's not a sprint. I think in this generation of young investors, you've seen, the meme stock era, a lot of, influencers on TikTok and Instagram, whatever, YouTube, telling you to buy this stock or that stock. So I think
too much information,
and a lot of it is, probably not in your best interest. They're not fiduciary.
Well, but if you look at all that information that's being thrown out there, you have to understand, you have to step back and look at it from a 30,000-foot view. Why is all that information out there? Why does everybody have an opinion? What is in it for the opinion giver? Think about that.
Right.
It's really to get clicks. It's really to get eyeballs, and that's how you monetize what you're doing. And it's it's the darndest thing when it comes to investing, because people are influenced by the stuff that we hear on a regular basis, and with the access to all the information that's out there today, both good and bad, correct and incorrect, your mind spins on this, and then you start making emotional decisions as opposed to rational decisions. And unfortunately, we're all emotional human beings. We act 3 times quicker on our emotions than we do on our rational thinking, and that gets most people in trouble. And I think that's where the Gen Z-ers are going to really have a problem, because their brain has been developed enough, and they haven't been through it to realize that, to look at the big picture.
That's
Does that resonate with you?
Exactly. And so for our younger investors out there, the Gen Zers and millennials, I would say, you may look forward to a bear market. Some of our retirees and, near retiree clients, maybe not so much, as they want to protect their nest egg. But like I said, investing is a marathon, not a sprint. It's the only store. What do we say, Joe? It's the only store where people run out of the store when things go on
sale. That's right. That's right.
So for our younger investors out there, if we have a bear market, which is again an average decline of 34% in equities, you're buying more shares on sale, which will eventually increase in value, and you'll end up with more wealth overall on the back end.
Right. But what happens when that bear market hits? The inexperienced investor, or the one that's driven by emotions, will do the thing that most people do because they're poor investors, is they bought high and they're selling low.
That's right.
And then they're waiting for the storm to clear, waiting till the sun starts shining again. And then they said, well, time to get back in. And then what have they done? Again, they've repeated the negative cycle.
Exactly.
They bought when it's high, and they're going to wait for the next bear market and sell when it's low.
And you don't lock in a loss until you sell.
Exactly. It's not a loss until you sell. Now, that's the key, of course, to having a plan, right? Knowing when you're going to need the money, and always have some dry powder that you don't have to sell when it's down. And that's what we do for our retirees. This is why we do retirement planning, because we know that stormy day is going to come, and the portfolios are built to be able to sustain you through that. It doesn't mean your portfolio won't decline in value, but it means that you will have the liquidity in the right positions, that you can access that cash and not have to sell some of the things that are down and suffering that bear market loss. Did I say that right?
You did.
Okay, well, continue.
So
You're doing a good job here.
how should a Gen Z or millennial investor be allocated in terms of stocks, bonds, and so forth? So a general rule of thumb that we use is 110 less your current age is the minimum percentage you should have in equities of your investable assets.
Okay.
So for example, somebody on the top end of the millennial generation, say they're 40 years old, 110 less their age 40 means that at a minimum, most conservative, their investable assets should be about 70% equities. Would you agree with that, Joe?
Yeah, of course. The younger you are, the more time you have to recover, and hopefully, this money is for long term. And I think the thing we talked about before we went on the air, it's a difference between investing and speculating. Speculating is the immediate hit, what's going on now in the next month, week, so forth. But investing is a long term. If you have that long term view, as you said, your allocation should be more heavily oriented toward equities, because that's where the growth is long term. But it's a bumpier ride. But the long term goal is where you're taking those bumps is you're going uphill.
Exactly.
It's a bumpy ride uphill.
Another key is to not fall in love with any one company. I mean, we saw this week Oracle stock shot up 36% in one day, I believe, due to their new AI contracts.
Right.
So again, a lot of investors are probably going to buy high, fall in love with one company. So here's a chart. In the year 2000, Joe, compared to 2025, the top 10 companies in the S&P 500, 25 years ago, how many would you say are still in the top 10 today out of 10?
How many? None.
One. Microsoft.
Okay. I didn't know what they were 25 years ago, but okay, well, yeah. And that's not uncommon. If you look at any 25-year period, that they rotate, they cycle out. I mean, we can also, well, I can remember companies like Eastman Kodak, Eastern Airlines, Polaroid, those companies that were bellwether companies that are come and gone.
Exactly. And some of these names from 2000, Cisco, Intel, Lucent, so forth, would have actually had less value over the next decade if you would have stayed the course when they were the top 10 companies
Mm-hmm. Right.
in the market in the year 2000.
Right.
So, some of our top names now, NVIDIA, Microsoft, Apple, Amazon, so forth. If history is any indicator of the future, you may not want to fall in love with overweighting those companies.
Well, I think the important thing too is that, at least for our listeners to know, is that we don't pick individual stocks. Right. I mean, the key to success for our clients and for our firm over nearly 50 years now is to find the very, very best money managers that manage the ETFs and mutual funds that make those day-to-day, week-to-week decisions. They have spent the time and money doing due diligence, investigating the companies, knowing what's going on in the industries, knowing what their competition is, knowing what their labor contracts are, and understanding the environment and making those decisions whether or not that should be bought or sold at any particular time. The strength that we bring to the table is finding those managers out of the thousands that are out there and the building portfolios around them. So I don't want to mislead our listeners that think that we're buying and selling stocks. That's not the business that we're in. Our business is pretty straightforward. Is building portfolios around the very, very best money managers in the world and building them to suit our clients' time horizon. As you said, the younger generation ought to be more attuned to having more equity mutual funds or ETFs in their portfolio for the reason we just discussed.
Diversification is key.
It is the number one key. Yep. Yeah. We've seen it, on the Callan chart that I'm sure you show your investors. I know we show ours, that a diversified portfolio will never be the top performer for the year. It'll never beat whatever's hot at the moment, whether it's large cap growth, whether it's real estate, whether it's small cap value. It'll never beat it, but it'll also never be at the bottom.
That's right.
And I think that's the important thing to remember. We're not trying to hit home runs. We're trying to be consistent single and double players, and that's the secret here. I hear the bumper music there. Josh, take it away.
Thank you so much, Joe Bert and Dillon Little, again with two certified financial planners with the Certified Financial Group, talking about the younger investor right now, and in the day of cryptocurrency and NVIDIA and Bitcoin, all these things. I wonder if people, have kind of lost that patience a little bit to play the long game. Everyone can yell buy the dip, but it's good to have a plan. It's good to have a team like Certified Financial Group, in your corner to help you get through that dip. If you want to join the conversation, 844-580-9326 is the number to call, 844-580-WDBO. Send in your open mic using the free WDBO app. You're listening to On the Money, where we're planning tomorrow,
Today,
with the Certified Financial Group.
By the host and does not reflect.
It's been so long since I've been doing this that I just don't even worry about anything anymore.
we're Certified Financial Group, where we're planning tomorrow, today. Black Monday, the dot-com bust, 9/11, and now two wars. We've pretty much seen it all. Acting as fiduciaries, our CFP professionals have been a steady hand guiding our clients to and through their retirement years.
No reason to be worried about anything.
Stay the course. You stay the course, and you get there.
I don't have to worry about it like I know a lot of people look at it every day. I don't have to do that with the team here at Certified Financial Group.
We're Certified Financial Group, where we're planning tomorrow, today. Are you tired of trying to reach your advisor through a call center and being put on hold for 20 minutes? That's why we don't use one, and our clients seem to appreciate the personal touch.
They always answer my questions and really care about what's going on with me.
You can trust what they say, and they do what they say, and it gives you a comfort feeling it's hard to find in the world today.
Waiting for you to call almost. You almost feel like that.
We're Certified Financial Group, where we're planning tomorrow, today.
As an investor, you want peace of mind. You need to know that your advisor is not only thoroughly competent, but also a fiduciary. In other words, he or she is acting at all times in your best interests. You need to trust your advisor, regardless of how much money you have to invest or what part of the world you're in. It might not be your money you're entrusting the advisor with. Perhaps you're a board member of a charity or foundation whose future depends on prudent investment. Or perhaps you have the responsibility of making investment decisions on behalf of other people. As the trustee of a retirement plan, the decisions you make can have a direct impact on the lives of your employees. Whatever type of investor you are, the solution is to use an advisor certified by the Center for Fiduciary Excellence. A CFEX certified advisory firm demonstrates its adherence to a global fiduciary standard of excellence, a defined standard with specific criteria covering 21 best practices. The documented, repeatable processes and the evidence-based decision-making that CFEX demands are more likely to generate investment portfolios that match client needs and expectations. And because the firm voluntarily agrees to a rigorous annual audit, investors can rest assured that their advisor continues to work to the highest professional standards. This independent verification is even more critical for trustees and investment committee members of retirement plans who are legally required to conduct regular due diligence on their service providers. Use a CFEX certified firm, and that job has been done already by an expert at no expense to the plan. So why leave anything to chance? Insist on working with investment professionals you can truly trust. Insist on using a CFEX certified advisor.
So you guys don't know Chicago, but I'm sure in your neighborhood you guys have an old school butcher where you walk in and there's a bunch of guys, no gloves, big white aprons, and there's Frank and there's Stevie and there's Mikey. And these guys know more about meat and more about animals and more about cooking the meat than any of us will ever learn. And so you walk in and you say, hey, Lou, I need to, I'm barbecuing this weekend, right? What do you like? And Lou goes to the big racks of stuff he has underneath the glass, and he goes, the veal chops, just in from Argentina, they are the bomb. And you go, veal, oh, I like veal. Well, what do you got on skirt steak? Oh, we got some great skirt steak, just came in yesterday from Montana. Skirt steak is one of my favorite, marinated up a little bit, it's fantastic. Lou will never say to you, Elliot, it's a little long on the meat here, big guy, your cholesterol is getting high. Why don't you go down to the fishmonger a couple blocks and have a nice piece of salmon? Right? He'll never do that. Why? His job is to sell me meat, and I go in, actually the same way I go into the Toyota dealership, because I like Toyota.
Welcome back to On the Money here on WDBO AM 580, always streaming inside your very own WDBO app. We got two certified financial planners sitting here in studio today. We got Dillon Little and Joe Bert, two certified financial planners with the Certified Financial Group. If you want to call in, we got open lines 844-580-9326, or feel free to send in your question using the open mic feature inside the WDBO app. Joe, Dillon, what do you say we head to Caroline calling in from Orlando?
We're here. Good morning, Caroline. Thanks for hanging on. How can we help you?
Thanks for taking my call.
Sure.
And okay, I'm going to take you off speaker. I am not a Gen X or a Gen Z. I'm a boomer, so sorry.
Good for you. Good for you.
I have a question.
Long live us boomers. Go ahead.
Yes, amen to that. So I started to take Social Security in, June. I did not want to do it, but I ended up with some health issues, quite unfortunately. I'm 63. And they can't seem to diagnose it, and it just made me, I had to quit my job temporarily. So I started taking the Social Security, totally did not want to do it. It was not my plan, but it is what it is. So my question is, as far as taxes go, now two things. I know with that big, beautiful bill, they say there's no tax on Social Security, but I don't think
No.
I think it's only for people 65.
No.
Only for $10,000.
Let's clear up what you just said right now, because a lot of people are under that misconception. When the president was campaigning, he was suggesting no taxes on Social Security. That never happened. It wasn't in the bill. It's part of the negotiation. They couldn't get that through. What we have is what's called a senior deduction, and this is for people 65 years old and older. between now and 2028, if you're single, you get an extra deduction of you get a $6,000 deduction for incomes of $75,000, modified adjusted gross income under $75,000 if you're single. If you're married filing a joint return, it's $150,000. $6,000 deduction. This has nothing to do with Social Security. Now, probably most everybody at 65 is on Social Security. I think that's why some people get it confused. So in your particular case, there's no senior deduction for you, and there's no Social Security free income for you right now. So what's your question?
Okay, so what that was part of my question, because I know that's not, I know what you're saying. I know that was not true, the way they're saying on the news. Oh, well. Anyway, my question is, how is it taxed? I'm going to be taxed on it, I'm guessing.
Yes.
I'm not working right now, so I really don't have any income, except I am trying to sell my house this year and move up to North Florida to be near my daughter. So I may have some capital gains, but with the $250 deduction, I don't think it's going to be a lot. But anyway, I'm not sure what else qualifies for income, but I feel like that's kind of, at this point, going to be my only income plus Social Security. So
Okay.
that's the question.
Okay. Well, first of all, it's whether or not how much is subject to tax, and then how much it's subject to tax, which you have to pay taxes on. Are you single?
Yes.
Okay, you're single. So here's the.
Well, I'm divorced.
Okay.
So, yeah.
Okay. You're filing a single return.
Yes.
Okay. So if your income is under $25,000, there's no tax on your Social Security. If you're 25 and 34, 50% of the benefits may be taxed. And if your income is over 34,000, up to 85% of the benefits may be taxed. That's not 85% a tax bracket. It's 85% of those benefits are going to be taxed. So let's say that your income is going to be over $34,000. Then you take 85% of that, whatever that benefit is, and that's added to your regular income, and then you pay taxes at your ordinary rate. That's the way it works.
Okay.
Does that help you?
Okay, but as far as the lower one, since I'm not working right now,
Yep.
and I will be making, I guess, less than $25,000, because the Social Security is not considered. Is that part of figuring out income, what my income is for the year, adding in?
I don't believe it is.
But the capital gains if I sell my house.
Yes, yes. Well, capital gains is going to affect your overall taxation. And,
Okay, so then under 25, no tax.
yes,
Is that what you're saying?
yes, yes.
No tax.
No ta-
Really?
yeah.
I've been saving 15%, but so good. I'll invest it.
Right. Yeah, I want to be sure we're talking apples and oranges. We're not confusing apples and oranges here. So what was your income so far this year? We're going to do a little calculation while you're off the air.
Well, I only worked in January.
Right, okay.
And then I had to quit my job at the end, and that was $4,000.
Okay. So chances
I
are...
did take two rollovers. I took two rollovers for $15,000 from my IRA to live.
Oh, okay.
Yeah.
That may affect the whole... So how much were the rollovers? $15,000 apiece?
No, total.
Okay.
An 8 and a 7.
8 and a 7,
So
15,000.
that's $19,000.
Okay, I think you're going to be under the wire here. But let me confirm on the taxation and the Social Security. Stick around to after break. I'll have an answer for you.
Thank you so much, Caroline. You want to join in? We got Joe Bert and Dillon Little, 2 certified financial planners with the Certified Financial Group, available to take your questions live on the air. 844-580-9326, 844-580-WDBO. You're listening to On the Money, where we're planning tomorrow
Today.
with the Certified Financial Group.
The decisions you make can have a direct impact on the lives of your employees. Whatever type of investor you are, the solution is to use an advisor certified by the Center for Fiduciary Excellence. A CFEX certified advisory firm demonstrates its adherence to a global fiduciary standard of excellence, a defined standard with specific criteria covering 21 best practices. The documented, repeatable processes and the evidence-based decision-making that CFEX demands are more likely to generate investment portfolios that match client needs and expectations. And because the firm voluntarily agrees to a rigorous annual audit, investors can rest assured that their advisor continues to work to the highest professional standards. This independent verification is even more critical for trustees and investment committee members of retirement plans who are legally required to conduct regular due diligence on their service providers. Use a CFEX certified firm, and that job has been done already by an expert at no expense to the plan. So why leave anything to chance? Insist on working with investment professionals you can truly trust. insist on using a CFEX certified advisor.
So you guys don't know Chicago, but I'm sure in your neighborhood you guys have an old school butcher where you walk in and there's a bunch of guys, no gloves, big white aprons, and there's Frank and there's Stevie and there's Mikey. And these guys know more about meat and more about animals and more about cooking the meat than any of us will ever learn. And so you walk in and you say, hey, Lou, I need to, I'm barbecuing this weekend, right? What do you like? And Lou goes to the big racks of stuff he has underneath the glass, and he goes, the veal chops, just in from Argentina, they are the bomb. And you go, veal? Oh, I like veal. Well, what do you got on skirt steak? Oh, we got some great skirt steak. Just came in yesterday from Montana. Skirt steak is one of my favorite, marinated up a little bit. It's fantastic. Lou will never say to you, Elliot, it's a little long on the meat here, big guy. Your cholesterol is getting high. Why don't you go down to the fishmonger a couple blocks and have a nice piece of salmon? Right? He'll never do that. Why? His job is to sell me meat, and I go in, actually the same way I go into the Toyota dealership, because I like Toyotas, and I trust the salesman to sell me a good product if I trust him. And the fact that he's got my interest at heart vis-a-vis my expectations for selling me that thing. By the same token, when I go to see a dietitian, I know she's going to look at all of my labs, she's going to take all the measurements, she's going to run all of her analysis, and she's going to absolutely give me her best thinking on what's best for me. Whether she's a vegetarian or a meat lover, likes this, likes that. If she thinks I should be doing something differently, even if it's not good for her, she's going to give me an opinion that's for my interest. So what's the difference between a fiduciary and the brokers? Well, these are dietitians, these are butchers. It's that simple. Brokers are butchers selling product. Fiduciaries are dietitians looking after your health. The problem is most people think that their butcher is a dietitian. So when one of your moms or dads or friends calls the broker and says, I got 200 grand, I sold a little piece of property, or I got some inheritance, what should I do with it? They're going in thinking they're talking to a dietitian, and they're really talking to Lou the butcher.
What is a fiduciary? When it comes to investing, a fiduciary is legally required to act in your best interest. For 40 years, planners at Certified Financial Group have been guiding our local clients toward financial peace of mind. The rest of the world is still catching up, but our team of certified financial planners are the local, experienced fiduciaries you can trust. Certified Financial Group are your Central Florida planners. Call us today.
40 years ago, I had a dream of building the best personal financial consulting firm in Central Florida. Now, with 14 certified financial planners acting as fiduciaries, I believe we're there. But don't take my word for it.
As we approach retirement, we have the freedom of choice.
Peace of mind that we now have, that's everything to us.
The people that work here are honest and caring, and I feel like I can go to sleep at night.
So schedule your no-obligation visit today at financialgroup.com, or we're planning tomorrow, today. For more than 40 years, our certified financial planner professionals, acting as fiduciaries, have been providing retirement
to On the Money here on WDBO AM 580, always streaming inside your very own WDBO app. If you want to join the conversation, we got some open lines, 844-580-9326, 844-580 WDBO. Joe Bert and Dillon Little, two certified financial planners with the Certified Financial Group, in the middle of talking to one of our callers right now, Caroline, who is entering Social Security and had some questions. Go ahead, Caroline. You're back on the air.
Caroline, so we left you, we were talking about what your income is and whether or not your Social Security be subject to taxation. So let me clear this up for our listeners. First of all, we want to look at the taxation of Social Security and the taxation on the benefits. So it's taxation of the benefits and taxation on the benefits. So first thing we have to determine is a taxation of the benefits. Are any of your benefits subject to taxation? So the first thing we look at is what's called your combined income. Okay, your combined income is what's called your adjusted gross income, which is virtually all of your income that shows up on the front page of your 1040. That's your dividends, interest, capital gains, distributions from your retirement plans, all that stuff. That's before itemized deductions and personal exemptions. And then you have to add back to that your municipal bond interest if you had that, and then half of your, whatever your Social Security benefits are. So you start out with your adjusted gross income, you add back municipal bond interest and half your Social Security benefits, and then if that number is less than $25,000 and you're single, none of your benefits are subject to taxation. If you're over $25,000 and under $34,000, then 50% of the benefits are going to be subject to whatever your regular tax bracket is. And if you're over $34,000, then 85% of the benefits may be taxed. So you have to figure out whether or not you're subject to taxation at all based on what your combined income is, and then you pay taxes on whatever's left. Does that make sense to you?
Yeah, except that part where you said half the Social Security. I thought you said that's not considered income Social Security. Now you're saying
yes. I wanted to clarify that for you because it didn't ring quite true when I said it, and Dillon cleared it up for me here. Yes, you have to add half your Social Security to whatever your adjusted gross income is, and that's the money that you took out of your 401k and your earnings for the year, and any municipal bond interest if you had that, and then if that's under $25,000 for you, none of your you don't pay tax on your Social Security. If it's over $25,000, then you're going to pay taxes on 50% of that benefit.
okay. So basically, just quickly in a nutshell, I don't get that much. I mean, I get $1,300. So that comes up to about $16,000 a year.
Okay.
So I would be taxed on part of what I'm going to add in is $8,000.
$8,000. That's right.
That's half of it.
You got it.
And then those two rollovers I took, which is 15.
That's 23.
And then I made 4 in January,
That's
and I haven't
27.
worked since.
That's 27.
But I did take, so I got the rollovers in there. The only other, so that's 27 right there?
Right.
Yeah.
Right.
And then what about if I'm thinking I'm going to make 20 in capital gains because I've got the 250 deductible. Does that count as income?
Yes.
It does.
Yes.
Okay. So if I add 20 to that, so then I'm at 47,000.
Yes. So 85%.
Well, I look rich.
85% of whatever you got then in Social Security will be subject to taxation. It's not 85% taxes, 85% of the benefit.
Right. No, I understand.
Okay.
Yeah, multiply the 27,000 and then multiply that 48,000 or whatever I said times 85%, and that I'm going to have to pay tax on.
No.
16,000.
The 16,000
a month times 85%.
Okay, repeat that. I'm so sorry.
The $1,300 a month, your current benefit times 85%.
That's
the taxable amount.
That's the taxable amount.
$1,300, your current benefit.
I thought it was 85% of all that when I just added it up.
No.
My income.
No. You're not paying attention here. Let's back up. Let's back up. What we want to look at is the taxation, how much of the benefit is subject to taxation, and then how much of that that's subject to taxation you have to pay taxes on. So as we just said, 85% of whatever your benefit is will be subject to taxation. And then you're 85% of, what did you say your benefit was? 13, what did we figure out?
1,300.
1,300. Okay.
A month,
Okay.
yeah.
So 13,000, do some math. Yes. So you have to pay taxes on.
15,600.
Yes. You have to pay taxes on that 15,600.
Well, 85% of it.
Yes. 85% of that.
85%.
Is added to your income. That's correct.
Okay, and then the other things are taken up by regular income tax.
Yeah.
The other tax I have to pay on, like the rollover and all that kind of
Yes,
stuff.
yes. And
Okay, well, that makes more sense.
yeah,
Yeah.
chances are with your standard deduction, you may not be paying any taxes. I mean, you're gonna come out okay.
I don't know. I pay every year, and I used to only make like $40,000.
I understand.
Yeah, it's
I
crazy.
understand.
Okay, well, thanks for your show. You've helped me out so much. I appreciate it all the time. I
Okay,
listen a lot.
we appreciate
Okay, you guys
your
do a
call.
great job.
Thank you so much.
Bye-bye.
Thank you. Yeah,
Yes, thank you. Bye.
and while we're on that, Dillon, we're doing now Social Security Analyzer that we have available for our clients to look at when the best time to take Social Security and all that stuff. Because Social Security is complicated in terms of the taxation of it, when to take it, what age to take it, whether you're single, married, are you a widow, all that kind of stuff, survivor benefits, all that stuff. So we have the ability now to do some really sophisticated calculations here in office for our clients. So if you're considering retiring and you want to look at what that situation might be for you, it's what Dillon and I and the 15 other certified financial planners do for our clients day in and day out, providing retirement planning for a fee. If you want more information about who we are and what we do, go to our website. That's financialgroup.com, financialgroup.com. So we left off, Dillon, on talking about the Gen Zers and what they're going to do when it comes time to retire. Or not time to retire, but during the next bear market.
Right. So I think I left off on the topic of diversification. So in the last decade, which is, a huge portion of Gen Zers and millennials, time they've been invested in the market, we've seen a period where U.S. stocks have, greatly crushed international stocks. So, many portfolios of Gen Zers and millennials may not have very many international stocks at all in them. So over the last 28 years, U.S. stocks have outperformed international stocks 56% of the time.
Okay.
So 44% of the time, international stocks have outperformed U.S. stocks.
That's why diversification is important.
Not saying you should bet the farm on international stocks, but it's a prudent part of any diversified portfolio, as we're seeing this year.
Right. Yeah, this right now international is outperforming domestic, and that is the key to long-term financial success is have diversification and not try to pick individual stocks, but recognizing that's an asset class that you need some diversification in. And this is where the professional money managers come in because their due diligence takes them all around the world of investing in these companies that you and I have never heard of, but are big companies in their particular region and are doing quite well. So what else do you want to add to that?
So, I would say that Gen Zers and millennials, now we have everything on our phone. You got Robinhood, you can start with $1. There's all these ads for all these apps, Acorn, so forth. Investing, getting in the market is the easiest it has ever been.
Right.
So here's some stats. So the average Gen Zer starts investing at 19 years old. The average millennial starts at 25 years old. And the average Gen X, so before millennials, didn't start until age 32.
Wow. And how about baby boomers?
Baby boomers, I don't know.
Oh, I can tell.
I would assume probably around the same age as Gen X, maybe a bit older.
Yeah, for sure. And that's because the information, it wasn't as easy.
Exactly.
You had to deal with the
everybody had
broker,
access.
didn't have, right, and it wasn't as, the information wasn't as available as it is today, and everybody thinks they're an investment genius because you just heard it on the news, and this is what your brother-in-law said, and you're right, it's so easy, you pick up your phone and dial in, and therein lies the problem. It's because I think, unfortunately, many people conflate investing with gambling. It's it's the same thing. You get that dopamine hit on your phone, and you're feeling good. And unfortunately, we saw what Robinhood did in their apps. They gamified it. You made money, and the whistles went off, and the balloons went up, and colors, and you got that dopamine hit. It gets you back to the phone. Let's do it again. Let's do it again. Let's do it again. And friends, that is not what investing is all about. That's speculation. That's gambling. And I think this is where the Gen Zers are going to have a rude awakening if this is what they've been doing. And that is a whole. There's a lot of stuff been written here in the last 24 hours about Charlie Kirk, and I think the impact of social media and the availability of information, good and bad, is really having a huge impact on society overall.
Too much information.
Too much information, and the algorithms are driving it to get people to react in certain ways. And the same thing with investing. It's best thing to do is throw the damn phone away, to be honest with you. So anyway, I digress. What else do you want to say on that?
So what do? Like I said, don't bet on any one company, because these companies fall in and out of order.
Mm-hmm.
Follow a disciplined strategy. Right. Put money away consistently. The leg up that the younger generations has, if they're starting earlier, that's more compound interest on their side. Compound interest is your best friend. Starting earlier makes it way easier for you on the back end versus starting later. The best time to invest was yesterday. Second best time is today. Yeah. Right, Joe?
No question.
Don't follow the financial advice of influencers, people online that you don't know what they're about. I would say talk to a fiduciary, talk to a certified financial planner professional, somebody who's obligated to ask in your best interest. Something I've done in the past is I've sat down with grandchildren and children of clients, who want their children or grandchild to get on the right foot, see, check on where they're at, point them in the right direction. So that's something that we offer for our clients, should that interest them, to make sure that they start on the right path.
Right. And you mentioned,
don't fall into some of these traps.
You mentioned about starting early. If you have a retirement plan at work, use the dadgum thing.
That's right.
Put the money aside and don't look at it. And as you know, your allocation, the younger you are, the more aggressive you need to be, because you have great time. This is really for the future. It's for 20, 30 years down the road. That money, I guarantee you, will grow. It's not going to be a smooth, straight line. Don't be jumping in, jumping out of the market. Just have the disciplined approach to pay yourself first. Take it out of your paycheck. You don't pay taxes on it until you withdraw it. And if you're a low enough tax bracket, put it in the Roth side of your 401k. But this is the way you can ensure that you're going to have a far better future than 95% of the folks out there that just aren't using their retirement plan. I hear the bumping music there, Josh. Take it away.
If you want to take it, I'm your guy. 844-580-9326 is the number to call. If you want to hop on the air with Joe Bert and Dillon Little, two certified financial planners with the Certified Financial Group, 844-580-WDBO. You're listening to On the Money, where we're planning tomorrow,
today,
with the Certified Financial Group.
but our team of certified financial planners are the local, experienced fiduciaries you can trust. Certified Financial Group are your Central Florida planners. Call us today.
40 years ago, I had a dream of building the best personal financial consulting firm in Central Florida. Now, with 14 certified financial planners acting as fiduciaries, I believe we're there. But don't take my word for it.
As we approach retirement, we have the freedom of choice.
Peace of mind that we now have. That's everything to us.
The people that work here are honest and caring, and I feel like I can go to sleep at night.
So schedule your no-obligation visit today at financialgroup.com, or we're planning tomorrow, today. For more than 40 years, our certified financial planner professionals, acting as fiduciaries, have been providing retirement planning and asset management for a fee to countless families across Central Florida.
We've been with Certified since 1992.
We're now into the third or fourth generation of clients that have come to CFG and the team here to do a great job.
It's been so long since I've been doing this that I just don't even worry about anything anymore.
We're Certified Financial Group, but we're planning tomorrow, today. Our fiduciary approach of providing retirement planning and investment management for a fee seems to resonate with our clients. But don't take my word for it.
I knew a gentleman that I worked with who had come to Certified Financial Group.
A friend of mine recommended them, and they were totally correct how good they are.
I had heard from somebody else that it was the best one in town.
I've sent several of my teacher friends here.
We're Certified Financial Group, but we're planning tomorrow, today. You may be new to the area, but we're not. For more than 40 years, our certified financial planner professionals, acting as fiduciaries, have been providing retirement planning and asset management for a fee to countless families across Central Florida.
We've been with Certified since 1992.
We're now into the third or fourth generation of clients that have come to CFG and the team here to do a great job.
It's been so long since I've been doing this that I just don't even worry about anything anymore.
We're Certified Financial Group, but we're planning tomorrow, today. Black Monday, the dot-com bust, 9/11, and now 2 wars. We've pretty much seen it all. Acting as fiduciaries, our CFP professionals have been a steady hand guiding our clients to and through their retirement years.
No reason to be worried about anything.
Stay the course. You stay the course, and you get there.
I don't have to worry about it like I know a lot of people look at it every day. I don't have to do that with the team here at Certified Financial Group.
We're Certified Financial Group.
AM 580, always streaming inside your WDBO app. Your chance to hop on the air with 2 certified financial planners with the Certified Financial Group. We got Dillon Little and Joe Bert walking us through another great hour of radio. Available at 844-580-9326. If a question pops into your head after 3 minutes from now, they have an option for that as well. Certified Financial Planner Charles Curry taking calls off the air at the offices of CFG at 407-869-9800. 407-869-9800. Let's head out to Orlando where Peter's calling in. Go ahead, Peter. You're live.
Morning, Peter. What's up?
Yeah, hi, good morning, guys. You know, the question is, with Powell lowering the interest rate probably coming up in next week or whatever, in your opinion, how will that affect the stock market? Is it just a guessing game whether they'll sell off, they'll go up or go down? Is there any steadfast when the interest rates are going to be lowered, or is it just a guessing game? Thank you. I'll listen to you on the radio. Thank you very much.
Sure. Well, first of all, the rate cut has already been baked into the markets. Wouldn't you say, Dillon?
I would say so. So we had some slightly higher than expected inflation data come in this week. So, you know, if the market receives a cut lower than what it was pricing in, or less, you know, for the remainder of the year than it was pricing in, that may be a negative for the stock market,
right,
versus what was already priced in.
Right. But I think Peter's question is generally lower interest rates when the market anticipates them coming is a positive for the stock market.
Right.
And so what's happened, in fact, we had records across all 3 indices this week. We had that trifecta on Tuesday, where all the major indices, the S&P, NASDAQ, and the Dow all closed at record levels. And that was a result of the numbers that came out in anticipation of perhaps a 50 basis point or 0.5 or 1% rate cut coming in. So that's already baked in the market. Now, if we only get a 25 basis point rate cut, I still don't think that that's going to be negative for the market. The other side of this is if we get a 75% basis point. I had a conversation with a client yesterday. What if they go to 75 basis points? Well, I think that says that they're seeing something, a real softness in the economy, perhaps, and a need to boost the economy a little bit more. And who knows how the market will react. It's funny. The information is released on the PPI, CPI at 8:30 in the morning. The markets react immediately. They go down, and by the end of the day, they're up. Or conversely, they get the news at 8:30 and it goes up, and by the end of the day, it's down for whatever reason. So a lot of tea leaves being read, a lot of algorithms that kick in there, a lot of profit taking, a lot of rebalancing of portfolios. All we know in the long term, Peter, is that the markets are up, never a smooth straight line. The key is to be diversified. I see we're running up against our time slot here. Let's remember that Charles Curry is taking calls off the air for our listeners. So if you couldn't get in today, we appreciate your tuning in. And Caroline's call really made me think about how our program is different from every other financial show that's on the air on the weekends. They're all 1 hour infomercials. Here we are trying to help our listeners, trying to give you advice that perhaps you can use, give you some ideas that you can use. I think that's the distinction here for On the Money, and we're proud that you joined us this morning. So once again, I've got a workshop coming up on October the 8th.
Yep, that's Social Security Planning, Basic Rules and Claiming Strategies. That's hosted by Charles Curry here in our office, October the 8th at 6:30 p.m.
So that's on a Wednesday evening. Go to our website, financialgroup.com. You can make your reservations right there. And we hope to see you, and best wishes to everybody. Have a great weekend.
Thank you so much. You've just listened to On the Money, where we're planning tomorrow
today
with the Certified Financial Group.